Today we're going to do a deep dive into the one question that every property investor asks. They ask it at the start of their journey in property investing, and they ask it right the way through. And that is, should I be paying interest only on my investment loans, or should I be paying principal and interest? So my name is David Thomas, Managing Director of Trilogy Funding, and for nearly 20 years I've been helping property investors maximize what they can do and build smarter portfolios. And by the end of this video, you'll know when you should be using interest only and when you shouldn't. So let's start with simple. What is principal and interest? Well, obviously principal and interest is where your monthly repayment contains an interest component, but also contains a principal component, which means you're actually paying off the loan little by little, amortizing that loan over the term of the loan. The term of the loan might be 20 years, might be 30 years, but every month you're contributing a little bit extra to the loan to reduce the principal, the amount that's owing. Whereas interest only, you're not paying off the property. You're not creating any equity in the property. You're simply paying the bank the interest on the money that you have borrowed. Nothing more, nothing less. Only the interest. So why would anyone choose not to pay off their property? Well, property investment isn't about paying things off. It's about leverage, and it's about holding the most amount of property you possibly can to create or get the most amount of growth. So why would you choose interest only? Well, it comes down to one simple thing. Cash flow is king. Anyone who's invested in property knows that it's not debt that gets you in trouble, it's running out of cash that gets you in trouble. Interest only helps you hold more property because the cash flow is better. But how much better? So the difference between having a loan on principal and interest and having a loan on interest only may be a monthly payment difference of 30 to 40%. So for argument's sake, a $700,000 loan on principal and interest might be $4,200, whereas on interest only might be $3,400. Now, that's a lot per month. And you've got to ask yourself, what could you do with the difference? You could use the difference to hold the property, pay for property holding costs. You could use the difference to pay down your home loan faster, or you could use the difference just to put in your offset account and create a buffer. Or maybe if we're making additional payments off our home loan, we're creating more equity in our home whilst we're holding the tax deductible debt higher on our investment property. So the next aspect is the tax angle. So when you have an investment property loan, the interest is deductible, not the payment. So if you have principal and interest payments, out of each payment, you've got part of your payment that is deductible interest and part of it that is non-deductible. Whereas if you have interest-only repayments, all of your payment is 100% tax deductible, which makes a big difference. So this is why the classic strategy that people use is having their owner-occupied properties on principal and interest, non-deductible debt, and having their investment properties on interest only. That way, they are maximizing their tax-deductible debt whilst minimizing their non-deductible home loan debt. This strategy helps you pay off your bad debt first whilst holding on to your good tax-deductible debt for as long as possible. Many people have used this strategy to save thousands of dollars in tax, meanwhile creating as much equity as possible in their owner-occupied properties. The next reason to consider interest only is because of leverage and growth. Now, if you've got your properties on interest only, therefore you'll have more cash flow. The next major reason is leverage and growth. Now, if you've got lower payments on your investment properties, then this might give you three options. Number one, you might be able to use that cash flow to purchase or qualify for loans for more properties quickly. You might also be able to secure more properties and build a bigger asset base because your holding costs are lower. And if you do buy more properties, then you are spreading your risk and becoming a smarter investor. You have to remember, the real thing that property investors are looking for is they're looking for capital growth. No one ever got really, really wealthy out of property by not having capital growth in their portfolio. And of course, the more properties you hold, the more chance you have at capital growth. There's an old saying, which is no one ever saved themselves to be wealthy. And in residential property, that's somewhat true. It's very hard for you to save $1 or $2 million over your lifetime. But to buy properties that will increase in value by $1 or $2 million over your lifetime, well, that's a fair and reasonable bet that could happen with a well-chosen, well-structured portfolio. Now, another key reason is flexibility and liquidity. As I said before, having a lot of debt isn't a problem, but running out of cash is. So if you've got a few investment properties and they are all on interest only and you have better cash flow on all of those properties, and you can use that cash flow to put in an offset account, and that offset account's against an interest only loan because home loans paid off. Therefore, what you'll end up with is the ability to save on interest costs, the ability to build a big buffer in that offset account. Now you can use those funds for whatever life throws at you. You can use them to improve your properties. You can use them to do capital works that are essential. It gives you the option to determine how you're going to spend your surplus cash flow. If you have your loans on principal and interest, the bank is determining how you're spending your surplus cash flow, using it to pay down the loan. That ability to determine where your funds are best placed should be your decision as a property investor. And one more thing to remember is that many property investors, their goal for that property or that loan in a couple of years' time is either to refinance that loan or to sell that property and realize their capital gain. Now, if you're only going to sell the property in the future anyway, then you're kind of wasting your own energy trying to pay down the debt when you're really just going to sell it and release the equity later on down the track. Now, it's not all wine and roses when it comes to interest only. There are a few downsides that we need to have a chat about. So, number one, you're not creating any equity in the property. So unless the property goes up, you're not up in value, you're not going to make any money. Number two, the cost of interest only loans, the interest component, the rate is usually slightly higher than what it would be if it was on a principal and interest loan. So there is a slightly higher rate of interest for interest only loans. We need to take that into consideration. Also, interest only loans are regarded as a short-term facility. Most interest only loans only run for about 5 years, and at the end of the 5 years, the loan will either need to be refinanced or it will roll to principal and interest. So it's not a long-term solution having all of your loans on interest only. And lastly, if you do have your loan on interest only for an extended period of time, 5, 10, 15 years, and the comparison between the amount of interest that you would pay over that 15-year period on that one loan and an interest-only payment for the entire time versus what you would pay on that same loan on principal and interest payments, the difference is that you would pay far more interest by just having the loan on interest only over that longer term. But property investing isn't about saving every last dollar in interest costs. Property investment is about leverage and buying more assets. So interest only isn't always the best, right? And there are some certain circumstances when principal and interest might be the best. So let's have a quick look at these. Now, when you're nearing retirement, your owner-occupied property is paid off, it would make sense to start to pay down some of these loans. The more equity that you have in these properties as you near retirement might be better for you. The next time that you might consider paying principal and interest is when the loan to value ratio on the property that you purchase gets to a point where the property is already cash flow positive. So if it's already cash flow positive and you've got nothing else to do with the money, then by all means, let's start to pay off the debt from that point in time. Now, one other reason that you might consider paying principal and interest on some of your loans is that if you have these loans moved to principal and interest and you're making payments on them, you're reducing the debt, therefore you are clearing the way for future borrowings. So the less debt you have on your old loans, the more likely a bank is going to give you money for your new loans. And the last reason is I've got clients that just sleep better at night knowing that every month they are in a little bit less debt than what they were the month before. So the last reason is personal preference. You might be at that stage in your life where you just want to be reducing your debts. So what's the smart investor's approach? Smart investors know that it's not a one size fits all, and that there is a time for interest only and there is a time for principal and interest. So interest only loans should be used when you're in your acquisition phase, you're trying to accumulate more property and you're trying to acquire new assets. And then principal and interest is used towards the end of your investment phase when you're trying to reduce your debts and prepare for retirement. Regardless of which one you are using, you should always consider having surplus cash sitting in your offset account to give you buffer and safety and prepare for a rainy day. And lastly, regardless of what structure you're using, you should review your structure every couple of years. You should review your lending options every couple of years to make sure you're staying ahead of the curve. Property investing is all about control, cash flow, and clarity. Know exactly what you should be doing at what time and what your desired outcome is. So if you're unsure where you're up to, if you think that maybe you're not adopting the right strategy for your investment property portfolio, reach out. Let's have a chat. You can click on the link below and that'll give you a link to my calendar, or you can just follow me for more content, like and subscribe to our YouTube channel.